Sorry for the late coming. If you are waiting, and request to everyone to please keep your phone on silent mode and raise for the institute motto followed by national anthem. गंगा उच्चल जगदितरंगा तब शुभ नामी जागे तब शुभ आशीष मांगे धारी तब जय गाथा जन मंगलदायक जय भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे भारत माता की। वेलकम बैक फ्रेंड्स। दोस्तों, मैं चाहूंगा कि एक बार आप अपने लिए जोरदार तालियां बजाएं। तो इस संडे को इस मॉर्निंग में इतनी संख्या में आप आए हुए हैं, ये हमारे प्रोफेशन के प्रति हमारे सच्चे त्याग और समर्पण की भावना को दर्शाता है। नाउ इज द टाइम फॉर हियरिंग ऑडिट। Friends, we all know, everyone, public at large, government official, believes in our audit. जब भी कहीं खातों की बात होती है, एवरीवन से ऑडिटेड बैलेंस शीट देखा जाए। ये शब्द भी हमारी कर्तव्य निष्ठा को दर्शाती है। फ्रेंड्स, we are approaching the closing of the financial year. This is the most crucial time for all of us as a professional. Year-end audit is not just about compliance, but about applying our professional judgment identifying risk area and ensuring accuracy and transparency in financial reporting. Looking to this, today's topic is year-end audit consideration, updates, and focus area. Is extremely relevant for every practicing chartered accountant, even on chartered accountant in service and audit professional. Friends, we are fortunate to have two distinguished speakers with us today, CA Sidhant Rishi and CA Ronak, who is known for his deep knowledge and practical insights in audit and assurance. क्योंकि दोस्तों साल के अंत में जब अकाउंट्स की होती है पड़ताल, तब ऑडिट बन जाता है सच्चाई का एक बहुत बड़ा ढाल। आज ज्ञान की ज्योति लेकर आए हैं दो सितारे, सीए सिद्धांत ऋषि और सीए रौनक साहब देंगे अनुभवों का संदेश। You please, I request our coordinator, CA Ankush Gupta, to give a brief introduction of our speakers. Please.
Very good morning, friends. We have two young and dynamic speakers with us. CA Sidhant Rishi. Sidhant is a director with Indian Assurance Practice and has over 13 years of experience in audit of companies under US GAAP, Ind AS, and Indian GAAP, covering a range of industries, including pharmaceutical industries, power chemicals, and utilities, manufacturing, and automotive companies. With this very short and brief introduction, I request everyone to please welcome him with a huge round of applause. Our second dynamic speaker is CA Ronak Shah. Ronak is a director with Indian Assurance Practice and has over 16 years of experience in the field of auditing, financial accounting, and advisory matter of several large and medium-sized companies in life science and chemical sector. Again, with this very short and sweet introduction, I request everyone to please welcome him with a huge round of applause. And before handing them the dais, we'll be presenting them with a memento. And Rishi, please.
Are you ready, sir? Ready, sir? Friends, two announcements, one big achievement for our study circle and one for tour. I request our past convener, Rishi to give their view. Very good morning, friends. Thank you, Kailash जी. जेबी नगर स्टडी सर्कल ने मेंबर्स ने जॉर्जिया का जो टूर रखा है 21 से 27 मार्च, ये फाइनेंशियल ईयर के अंदर ही फॉरेन का टूर पेंडिंग था, वो रखा है. तो काफी एंट्रीज तो आ गई हैं. फ्यू सीट्स आर अवेलेबल टू कंप्लीट द टूर साइज. तो दोज हु आर इंटरेस्टेड कैन अप्रोच कैलाश जी. जो पुराने जाते हैं सुरेश जी वगैरह सब, वो तो बैठे हैं, वो तो उनका कभी ना नहीं होता है. तो काफी लोग ऑलरेडी ज्वाइन हो चुके हैं. 6-7 सीट्स खाली है शायद. यस. तो बहुत अच्छा टूर है. तो दोज हु आर इंटरेस्टेड कैन स्टिल ज्वाइन. और जो सबसे अच्छी खुशी की बात आज अनाउंसमेंट होने जा रही है. 2003-4 में आई वाज द कन्वीनर, some 22 years back. From स्कूल ऑफ बगड़का कॉलेज लाइब्रेरीज, वहां पर मीटिंगें होती थी. 2003 में आई वाज मेड ए कन्वीनर. देन आई शिफ्टेड द वेन्यू टू द कोहिनूर एंड 120 मेंबर का सीधा 555 मेंबर उस समय हुआ था. एंड द बेस्ट स्टडी सर्कल अवार्ड स्टार्टेड फ्रॉम दैट ईयर 2003-4. After that, JB Nagar CP Study Circle has never looked back. Every year, the Best Study Circle Award, the Appreciation Award have been coming to this, your own study circle. So this year also, I am very happy to announce that with the efforts of Kailash ji and entire team of JB Nagar and with your participation, we have again won this certificate. And we request Kailash ji to bring this here, so I will read it out for you. This is a very good moment for us. The Institute of Chartered Accountants of India, Western India Regional Council, Certificate of Appreciation. This certificate is presented to JB Nagar CP Study Circle of WIRC for their extensive support to the Western India Regional Council of ICI during the year 25-26. CA Ketan Sayya Chairman, Mumbai, 24th February 2026, CA India. So friend, this is for you. 24th year in succession.
Thank you, sir.
Congratulations.
Thank you, friend.
Good morning, everyone. Thank you for the very warm welcome. Thank you, JB Nagar CP Study Circle, for inviting us to present on this topic, which is year-end audit considerations and key regulatory matters. Thank you, all the conveners and coordinators, for this warm welcome. Thank you all. And thanks to all of you to come in such a large number on Sunday morning. Thanks a lot. So just to give you the brief agenda for our topics today, we would be covering the importance of year-end closing process, how important it is and what is the disciplined approach for year-end closing, revenue recognition and what are the key focus areas, documentation standards, management representation, common year-end observations in FRRB and QRRB reviews, impairment testing and key assumptions documentation, leases, deferred tax, covenant testing, technology and automation in the closing process, consolidation and NCI adjustments, and regulatory updates. So these are the topics we will cover in our today's session. If you have any questions, clarifications, we are here to answer to the best extent possible. So moving on, how important it is for to have a disciplined year-end closing. What are the key risk areas and key focus areas, and where the regulators are now focusing as part of the financial statements audit? What are the focus areas from the regulators' point of view? So we will touch upon these topics. So the year-end closing process is a very high-risk process. I mean, it's a very risky period where there could be material misstatements considering the short timelines for the closure of the audit. And there could be fraud because of the management incentives. There could be pressure on the management to achieve the targets. So all this could lead to a higher risk of material misstatement in the financial statement. And as auditors, we need to focus on some of the key and critical areas like revenue recognition, related party disclosures, going concern assumptions. So whether all these areas, have been properly covered, there is support, proper audit evidence to substantiate the audit work, and the files which the audit files as auditor we prepare contain enough documentation to substantiate our work. So some of the key areas in the revenue recognition would be the sales cutoff, the return and rebates allowances, the bill and hold arrangements, the channel stuffing, side arrangement or management override of controls. So to keep in mind all these focus areas, we need to ensure there is enough and robust documentation. We have obtained proper audit evidence for these areas. So we will look into some of the key aspects, what we will need as an auditor, we need to obtain and how we need to document those in our files. Then the regulatory focus has been on the, related party transaction, whether the related party transactions are complete, whether there has been proper business rationale for those related party transactions or not, whether the transactions are at arm's length, whether those are recurring in nature or non-recurring. So all these aspects we need to ensure while ensuring the year-end closing process. Then the audit implications, expand testing at the near or period end to ensure that there is proper audit evidence and we have obtained proper evidence in the files. Increase partner involvement and document rationale for sampling and judgmental areas. So at the year end, that there needs to be heightened activity or involvement from the partner or senior team members. The sampling or the audit testing which we do needs to be properly documented. Also, the documentation needs to include key judgments and estimates which have been used by the management, and how, as auditors, we have relied on those judgments and estimates, how comfortable we are, those needs to be documented in our files. So coming on to the revenue audit, what are the relevant assertions and what are the procedures for addressing the fraud risk relating to the revenue? So one of the key assertions in revenue is the occurrence, whether the revenue has actually occurred or not. So how do we test that, whether the revenue has actually occurred or not? So we, as an auditor, we vouch few samples on a test basis to see whether there is actual audit evidence, the supporting invoices, shipping bills, GST, e-way invoices now as after the GST has come in, there are e-way invoices, e-bills which are generated. So as an auditor, we need to have a corroborative evidence, and we can do some of these checks to ensure whether the revenue which is actually recorded in the financial statements is correct or not, and it's not fictitious. Some of the customized audit techniques also we can use to ensure that there are no duplicate invoices, there are no fictitious customers, or no unusual transaction patterns. We need to perform test of internal controls to around sales authorizations as well. Second assertion is on the completeness and measurement. So, as part of the audit, how do we ensure completeness? To ensure completeness, we need to ensure that the sales which is recorded in the financial ties up with the trial balance and the general ledger and the sub ledger. Whether the we need to perform analytical procedures, checks on the margin, percentages, returns, validate revenue measurement against the contract terms, whether the contract terms depict what the revenue is recorded in the financial statements, whether the rebates, discounts, allowances, variable considerations are in line with the accounting policy followed by the company or not. The last assertion is on the presentation and disclosure. Once we have ensured occurrence and completeness, the presentation and disclosure needs to be followed in accordance with the accounting standards. Whether the classification of revenue streams and related disclosures are complete, whether the judgments used in the presentation of revenue, whether that is accurate or not, whether there is a reconciliation between the financial statement and line items and the disclosure line items which is presented in the financials, and confirm that the accounting policy is consistently applied by the management. So increased fraud risk requires expanded substantive procedures and corroborative evidence for assertions most susceptible to manipulation, such as occurrence, measurement, and disclosures. Document rationale for testing, extension, and evidence obtained. So as an auditor, we need to document what are the evidences which have been obtained while testing the area of revenue. As discussed, some of the key assertions relating to income statement and balance sheet. So for income statement, we need to ensure the following assertions are covered as part of the audit, like occurrence, completeness, measurement, and presentation and disclosure. So occurrence is basically whatever is recorded in the financial is actually occurred and it's related to the entity. Completeness is basically all revenue and expenses that should be recorded in the correct period are recorded on. Measurement is at what amounts those need to be recorded and whether those are recorded based on the recognition criteria. And presentation and disclosure is basically items that whether those are properly presented and disclosed in the financial statements. For the balance sheet, some of the key assertions are, existence, valuation, and allocation, rights and obligations. So existence is whether the assets and liabilities actually exist at the balance sheet date or not. Valuation is whether the assets and liabilities are properly valued and recorded in the financial statements at appropriate amounts. And rights and obligations is whether the entity has legal rights and obligations to the respective recognized liabilities. So some of the procedures to address fraud risk would be, analyticals and inquiries. So as part of the analytical procedures, company as auditors, we need to ensure whether the month-on-month revenue or the customer-wise revenue, disaggregated data of revenue, whether those are making, whether there is a pattern or there is a trend, whether there is any anomaly, whether there are unusual transactions which needs to be further probed. So this can be done based on the analytical procedures, also using customized audit tools to ensure, whether there are any duplicate invoices or whether any round number transactions or invoice date after the shipping dates. So all these can be used through the analytical procedures. And inquiries, so basically targeted inquiries, inquire with the sales and marketing personnel, inquire with the other functional heads like the legal head, whether there are any legal matters or any contingent liability which may affect the revenue recognition. Conduct third party interviews or informal interviews across organization so that the other persons in the organization who are aware of achieving some targets or some anomalies in the accounting practice, those can be revealed through the informal inquiries with the other persons in the organization. Some of the additional steps or the targeted steps to address the fraud risk assertion, engagement and team design. Assign an experienced team member for high risk and fraud risk areas so that the engagement team personnel who is executing those areas is aware what are the risks, what needs to be further probed, how it needs to be looked at. engage specialists like valuation or IT to if there are any complex transaction or unusual transactions in revenue recording process. Unpredictability and sampling. So our sampling needs to be unpredictable. There can be extended sampling, verifying the nature, extent, and timing of the procedures, like surprise confirmations, extended cutoff procedures, increase sample size, and include items below the threshold. Because as management would be aware, we generally test some of high value samples only. So we need to have unpredictability in our sampling so that our sampling is unbiased and low value items are also looked at, and that can bring some element of surprise in our sample testing. Corroborative evidence, as I mentioned, interview with non-finance personnel, warehousing, shipping, customer service to corroborate a volume of shipping and timing of shipments, confirm contractual terms with the contracts, guarantees, and intercompany arrangements rather than just intercompany balances. And controls and procedures. So as part of the audit, we need to test controls around revenue recognition, authorization, price changes, and credit memos. Inspect invoices, agreements, shipping documents, e-way bills to ensure that revenue is properly recorded and there is a adequate supporting documentation for the revenue which has been recorded. And conduct background research, review whistleblower reports and other intelligence to ensure the revenue is appropriately recorded in the financial statements. In the audit of related parties, so as part of the audit of related parties, we need to identify who are the related parties, then inquire and document and do the risk assessment. So how do we identify the completeness of related parties? So when we start the audit of related parties, we obtain from the management the list of all related parties. We evidence that from the external sources like the MCA filing or wherever the directors are common in some of the companies to ensure the related party list is complete and accurate. Analyze vendor master or customer master to see whether those related parties or any other parties are having same address or same contact number, same email ID. Scrutinize transaction with unusual terms like interest-free loans or below market pricing for related party transactions. Yeah.
Now, a conventional method of when frauds can be minimized until enhanced control is for adding some checklist. Out of the box thinking, I mean, nowadays you can see a lot of frauds happening. Out of those, how those can be curtailed or minimized or can be changed?
So fraud, it's depends on the management intention and which areas like revenue, there could be pressure on the management to achieve the targets. So to curtail that, as auditor, we need to apply professional skepticism, ensure that whatever is recorded in the financial statement, there is corroborative evidence. We need to apply some analytical procedures to ensure whether there are any anomalies or whether there are any outliers. And we need to further probe into those areas and obtain sufficient appropriate audit evidence so that we can verify those and see whether the risk of fraud is mitigated or not. Of course, as auditor, we cannot do 100% testing, but through all these analytical procedures and using customized tools, analytics, we can find some patterns, anomalies, and address those risks to a greater extent. That will provide a greater assurance.
Now with the technology, people are talking about why not 100% possible. So when traditionally people do have sampling and all this. Now because of advanced technology and all this, there is good coming up, why not at 100% possible?
So as part of technology, that's what I mean. As part of technology and data analytics, 100% population analysis is possible, but not the vouching or testing is not possible. So when you do the 100% analysis through technology, you can find out the outliers, and then only you target your population or your testing to those outliers to see whether those are having proper evidence or not. And that's how we can get a greater assurance.
So maybe for example, bank, sorry, I think for bank is happening recently, or investment for bank happening recently. How to control all of this? Maybe happen.
Yeah. So, I mean, for the financial sector, we are from the manufacturing sector. So, financial sector, it has its own different audit procedures. So, we are not aware of those because we typically audit manufacturing clients in life science chemical sector. But as part of the analytical procedures, we can do 100% analytics and focus our testing on the outliers. So that's how those can be prevented. Yeah.
Some areas it is possible. So let's say, for instance, revenue government has a theory where you can check 100% of the population, but something like a lorry receipt still remains critical. And a lot of times revenue recognition is dependent on that. So in a lot of areas, technology is coming in that we are able to check 100% of the population. Control like this. You are correct that when you check 100% of the population, the risk of fraud goes down, but there are still some areas that there is manual intervention. And it becomes very difficult to check 100% of the population. There you will have to identify patterns and focus on that particular.
Yeah. So for the related party, as I mentioned, identification procedures, identifying the complete list and ensuring the completeness of the parties is first step. Then inquiry and documentation, inquire about changes as compared to prior periods. What is the business rationale for those transactions, whether there are proper authorization and approval processes for those transactions. Inspect the minutes of board meetings, approval processes, agreements, and executed contracts for evidence or if there is any influence. Validate whether management process identifies related party on a continuous basis. And risk assessment, so assess risk of material misstatement from undisclosed or misclassified related party transactions, including dominant influence by related parties or transactions affecting revenue or valuation. Consider whether the transactions are at arm's length and are recorded in correct period and at accurate amounts. So some of the audit consideration and responses to assess risk: obtain substantive evidence on the transaction purpose. So as part of the audit, we need to obtain proper audit evidence to ensure the transaction has a sound business rationale and whether those transactions are genuine or not. Confirm the terms and guarantees. So not only confirm the closing balances, but also confirm the terms or the guarantees through external confirmations. Test controls and examine the documentation for related party transaction. Evaluate financial capability and recoverability. So whenever a company is giving loan to another company, you need to ensure whether the other company has a financial capability or whether the loan is recoverable or not. Background research and whistleblower follow-ups, and finalize, evaluate recording and disclosures. Next topic is on the going concern and revenue recognition. So going concern is a fundamental to the preparation of the financial statements. Whenever the entity prepares its financial statements, it assumes that the entity will continue its operations in the foreseeable future, and there would be no liquidation. So some of the key regulatory standards and framework which apply going concern are, Companies Act, Section 129, 134, Ind AS 1, presentation and disclosures, Ind AS 10 on the subsequent events, SA 570 on the auditor responsibility, SA 700 on the audit opinion and guidance, SEBI LODR requirements. These frameworks require transparent evaluation and disclosure of material uncertainties. And management responsibilities. So as part of the going concern assessment, management needs to prepare the budget and cash flow projections, identify and challenge key assumptions, document plan for future actions, example, the cost reduction or the asset sale or refinancing, and assess the likelihood of those plans succeeding without undue uncertainty. So as part of going concern assessment, we need to ensure that there are robust plans and procedures identified by the management. There is a proper budget and cash flow forecast prepared by the management and the auditors. We need to challenge and assess based on the historical data or based on the current situation prevailing for that particular industry, whether the going concern assumption is proper or not. So, management assessment, some of the practical expectations is, forecasting and assumptions, financing plans and covenant, asset realization and operational plans. So, reconcile the forecast to the recent actuals, disclose major estimation uncertainties, sales growth, margin, working capital requirement, perform sensitivity analysis around the key assumptions and key drivers, whether there is a cash burn or whether there are covenant breaches, or whether the what is the recovery timeline for the cash flow. What are the financing plans and covenants? Review the existing borrowing facilities, whether the lenders would be agreeing to give additional credit or confirm the support in writing, whether the parent company will issue a support letter in case of a subsidiary if there are funding issues for that subsidiary, and whether the asset realization and operational plan, whether the company is planning to discard some of the assets, sell some of the assets, and what is the plan by when the money from those sale or discard of assets would be realized. What is the order backlog of the entity, and what are the collectibility assumptions used in cash flow model. So when forming a view on the entity's ability to continue as a going concern, we need to ensure whether there are, doubt on the, or whether there exists a material uncertainty on the entity's ability to continue as a going concern, whether there are any events or conditions that may cause significant doubt, or there are no such events. If there are no such events, then there is no risk. However, when there are doubts or whether there is a material uncertainty, we need to validate that with the projections of the management and ensure there are adequate disclosures given in the financial statement. And in some cases, also ensure whether there is a need to modify the audit report or what can be the reporting implications in the audit report. So some of the significant events and conditions that may cast significant doubt on the entity's ability to going concern are, operational and financial indicators like the recurring losses, continuous cash flow burn, recurring operating losses, loan covenant breaches, inability to access financing. So these are some of the operational indicators which may point out that going concern assumption needs to be further looked at. External and legal indicators, regulatory actions or legal outcomes, material contingent liabilities, adverse market or macroeconomic conditions affecting demand or significant change in the industry structure of the particular entity. And audit procedures to identify indicators. There would be some of the analytical procedures, review of interim results, minutes of board meetings, discussion with the legal counsel, confirmation of borrowing facilities, assessment of subsequent events, and evaluation of third-party support arrangements. Moving on to the next topic on the revenue recognition, top and variable consideration. So as part of the year-end revenue recognition, cutoff is one of the main assertion or main focus areas as auditors. We need to ensure whether the revenue which is recorded in the period end is actually pertains to the revenue which is there of the period end, or whether it needs to be postponed to the, or whether it needs to be deferred to the next financial year. So some of the key cutoff controls are, inspecting shipping documents, goods received notes, e-way bills, confirmation from the customers, reconciling sales journals around period end for manual entries posted that could affect revenue recognition. Incoterms and the timing. So we need to ensure whether the revenue is recorded as per the Incoterms agreed in contract with the customers, whether the determination of Incoterms is appropriate or not. So like in case of FOB, the revenue would be recognized during shipment, whereas in case of CIF, we need to ensure when the control is passing on to the customer, and accordingly revenue needs to be recognized. And in case of X work, similarly, what is the point when the control is getting transferred to the customer, and accordingly revenue needs to be recognized for those Incoterms. And what is the audit evidence? As auditors, we need to obtain, we need to match invoice date to the supporting delivery documents, like e-way bill or the lorry receipts. We need to evaluate cut-off journal entries, review sales returns after year end to adjust revenue estimates, and test completeness of sales return provisions. And one of the key elements in recording revenue is the variable consideration, estimation, and methods. So, as part of revenue recognition, variable consideration plays an important role under Ind AS as well as under Indian GAAP. So, variable consideration is basically nothing but the discounts, rebates, allowances, or whether there are any incentives or bonuses which would be paid as part of the revenue transactions. So how do we, as an auditor, we estimate whether the management has recorded revenue appropriately considering the variable consideration? So we need to first ensure what are the variable considerations in accordance with the contract with the customers, whether those are appropriately measured or not, whether there is a probability or uh, those will occur or not. And accordingly, we need to management needs to estimate, and as auditor, we need to test whether those estimation process is appropriate and whether the estimation process is robust, which is followed by the management and consistent. So, for example, for a portfolio of contracts, there could be multiple outcomes. So, compute probability weighted of sum of outcomes and document the probability model inputs and historical accuracy. And most likely method would be appropriate for binary outcomes, like whether there is a bonus payable or there is a no bonus, whether it's yes or no. And then select the single most likely outcome and justify with evidence and management judgment. And constraint could be high probable and no reversal. So it needs to be highly probable and there should not be any reversal which needs to occur based on the underlying contract with the customer. So some of the examples for variable consideration and the calculation and audit focus. So sales return. So based on the historical patterns, we can identify what is the percentage of sales return which the company is recording. And based on that percentage, management can record or just reverse the revenue based on the historical pattern for the sales return. For performance bonus, so for example, if a contract prices 1 crore with a 5 lakh performance bonus for early completion. And if the probability is 60%, then only 3 lakh needs to be recorded as a variable consideration, and that needs to be substantiated with proper audit evidence, and there has to be no reversal in the subsequent period for this variable consideration. And as part of the audit procedures we need to perform is to test the mathematical model, evaluate consistency with prior periods, corroborate inputs with external evidence, and review subsequent events for outcomes that confirm or adjust the estimates. The next in the revenue recognition is the principal versus agent assessment and indicators. So how do we identify whether the entity who is selling the goods is acting as a principal or is acting as an agent? So we need to ensure what are the terms of contract with the customer, who bears the relevant risk, like the pricing risk, inventory risk, collection risk, who is bearing all those risks. So in a manufacturing company, if the company is selling goods directly to its customers, then it acts as a principal and it will record revenue at gross amounts. Whereas in case of some industries like airline agency, it sells the tickets to the customers. However, it earns only a commission from selling those tickets. So in that case, revenue would be recorded at a net amount, that is only the commission fees and not the gross amount. And some of the judgments and documents. So assessment is fact specific and it requires documentation of controls, analysis, contract terms, and economic substance. As auditor, we need to corroborate the conclusion with contract review, flow of goods, and third party confirmations when necessary. Next topic is on the audit documentation. So once we have done the audit, majority of the findings from the external reviews or the regulators is on the audit documentation. And as it said, work not documented is work not done. So as auditors, we need to ensure whatever work we are doing is properly and adequately documented. So there is an auditing standard which says how the work needs to be documented, what are the protocols as auditors we need to follow for documentation of our work. And if we standardize our work papers and prepare standardized work papers, so it facilitates easy review for the even external regulators, and the review becomes very easy and smooth even for internal as well as external purposes. So the importance of audit documentation is its evidence as a documentation ensures auditors can demonstrate that the audit was carried out in accordance with the applicable auditing standards and legal requirements, demonstrates compliance with auditing standards and regulations, supports conclusion on financial statement assertions like the existence, completeness, valuation, rights and obligation, presentation and disclosures, provides evidence for supplementary review and follow-up work, facilitate subsequent audit and external inspections like regulators or the litigation or due diligence. So what is the requirement and where this is coming from? So SA 230 prescribes the documentation requirements. So as part of the audit, we need to document the nature, timing and extent for the audit procedures which have been performed. What are the results and evidence obtained as part of the audit? And what are the significant matters and judgment which have been applied in documenting the audit? So the standard audit work paper and its contents, how should the standard audit work paper be documented? So as part of the audit, the standard audit work paper needs to contain, all these aspects like standardized header, footer, what is the work done, actually describing what are the work procedures performed, and evidencing or cross-referencing those work papers to the relevant sheets or tabs. Work papers can be in soft copy or hard copy. So there needs to be proper referencing, indexing of the work papers, identification of the source of information, identification like third party or system generated, then verification, properly defining the footnotes or the audit tick marks to document what represents, which tick mark represents what procedures we have performed. So in summary, as part of the audit, the work paper should be, should speak its own language whenever there is any external inspection or there is any regulatory, so that the external reviewers don't struggle to find out what procedures were performed, how those were performed, what are the judgments which are involved in performing those procedures. So work paper should be speaking on its own if we have documented it properly. So proper work done, observation, conclusion, how those conclusions were reached, what were the significant estimates and judgments which were used to reach those conclusions, all needs to be documented in a robust manner. And if we standardize the work papers, I would say half of the majority of the work will become very easy if the work papers are standardized in a particular format, so that the review becomes very easy. Next topic on the written representation, audit, evidence, and management. So as part of the audit, even the management representation or the written representation from the management is very important to support our other audit evidence which we obtain during the audit process. So obtain management confirmation. So we secure a written representation from the management and where appropriate with those charged with governance, where they believe they have fulfilled responsibilities for preparing the financial statements and providing complete information to the auditor. It also supports other audit evidence. We need to use a representation to corroborate other audit evidence where the audit teams consider it's necessary or where required by standards on auditing, and respond appropriately, evaluate management response represents and take action when representations provided are incomplete or conflict with other audit evidence obtained during the audit process. including modification of the audit procedures or reporting implications. So essay on the auditing standards for the management representation, and there are some other specific standards on auditing which require written representation from the management, like essay 240 on the fraud reporting, whether management has acknowledged the responsibility of internal controls to prevent and detect fraud and disclose results of fraud risk assessment and knowledge of fraud or allegation affecting the entity. Essay 250 on the laws and regulation, whether all the laws and regulation completeness is ensured by the management and whether those have been appropriately disclosed and presented in the financial statements. Essay 450 on the uncorrected misstatement, whether the uncorrected misstatements and the turnaround effect of those uncorrected misstatements is immaterial to the financial statements or not. Essay 501 on litigation and claims, whether the litigation and claims have been identified when the management are complete, accurate, and properly disclosed in the financial statements. And Essay 540 on the accounting estimates, whether the accounting estimates and judgments used by the management for preparing the financial statements are complete and accurate. So standards on audit required represent. So Essay 550 on the related party transactions, whether the identification of related party done by the management is complete and whether the disclosure in the financial statement is complete and accurately disclosed in accordance with the auditing standards or the accounting standards. Essay 560 on the subsequent events, whether management has disclosed material subsequent events to the auditor or there is a disclosure in the financial statements. Essay 570 on the going concern assumption and Essay 710 and 720 for prior period reclassification or if there is any audit evidence which is not provided, whether that will be provided before the audit report signing date. Some of the common year-end errors observed in practice in the ICAI, FRRB, and QRB findings. So as part of its regulatory inspection, ICAI also conducts various inspections, and now even NAFRA has started various inspection of audit files of the firms. And from those, they have identified some key themes or critical areas where there could be errors or there could be misstatements or there could be presentation-related misstatements. So some of the key themes or key areas where these have been observed are area-wise findings. So majority it relates to the disclosures, 31%. As you can see, 31% observations are related to the disclosures. Around 20% are relating to the assets. Around 17% are relating to the statement of profit and loss. 12% are relating to the audit report. 6% relating to the Caro report, and so on. So these are some of the observations which have been bifurcated. And what are these observations? So these are very some common observation and some very low-hanging fruits which, if applied diligently, followed diligently, the method or the guidance, then these can be avoided. Like the ensure correct terminology in the financial statement. So that for lease liability, we just write lease liability, but the correct terminology is lease liabilities. Similarly, for revenue, it's total income. For shareholders' funds, it's equity. For deferred tax, it should be deferred tax assets net. For the assets, it should be property, plant, and equipment. So these are the correct terminologies which are defined in the Schedule 3 format as well for India's and Indian GAAP. And format missing details of the MSME, trade payables, subheads of income from operations like goods, services, or other operating revenue were missing in some cases. Then the sequence of line item was different. It needs to be as per the format prescribed under the Schedule 3, like intangible assets under development needs to be after intangible assets. Other current liabilities needs to be before provisions. So presentation and disclosure, accounting policy language is key. Related party transaction and disclosures. So don't miss through pass-through arrangements. Terms of all types of related party transaction needs to be disclosed. Entity-wide disclosure needs to be given if entity has only one reportable segment. Disclosure of evidence and amounts of restriction on title of PPE and other assets needs to be given in the financial statement. Judicious disclosure of significant judgments and estimates which have been used for preparing the financial statement needs to be given. Previous year figure disclosure in all notes and previous year reclassification disclosure needs to be presented. Some key observation from QRRB, like no depreciation was charged on standby or idle assets. Related party transaction, categorization of KMP remuneration into short-term post-retirement and long-term benefit was missing. Completeness of RPT transaction and the terms with the related party were missing in some cases. Then fair value of financial instruments, so asset and liability measured at fair value were not disclosed. Fair value hierarchy was not disclosed along with other relevant details. And revenue from contract with customers, the disaggregation data of revenue was not provided in the financial statements. So with this, now I hand over the next topics to Sidhant. If there are any questions, clarifications, happy to answer. Thank you.
So, continuing where Ronak left, we'll look at some areas which has been the focus for a lot of regulators, as well as we heard from all stakeholders in terms of these are the important areas for year-end closing. So on impairment testing, as far as financial assets are concerned, they are governed by Ind AS 109. But other than financial assets, whether it be property, plant equipment, whether it be goodwill or intangible assets, they are covered by Ind AS 36. So one of the things that we've heard regularly from regulators, so we've had NFRA review our files, we've had observations from QRB, is that you cannot take anything that the management says at fair value. So we all take projections in the course of our audit, be it for going concern, be it for assessment of impairment of goodwill, of intangible assets, and there are a set of assumptions involved. I think one of the key themes that we've seen in our reviews is that you've got to have a backup of all those assumptions. Anything that the management has given you needs to be challenged. So when we do impairment testing, what we see is what is the value in the books of accounts, what is the value, say, for property, plant equipment, and intangible assets, and whether that value is recoverable or not. When we say recoverable, whether they will generate sufficient cash flow which justifies its value in the books. So we compare the value of those assets in the books with the fair value. And if the value is lower than the fair value, then an impairment charge needs to be taken in the financial statements. The fair value can be calculated in two ways. One is what are the future cash flows that will be generated through those assets. So if you have a plant, you can look at what are the projections of those plants over the next 5 to 10 years. What is the cash flow that the company will generate? And discount that to its present value to see whether what its fair value is as of now. And the second method is if there are appropriate market-based estimates that are available, say assets of a similar type, what is the selling price of those assets in the market? What is a recent deal that has happened? What was the price of that deal? That too can be used to determine fair value. And if there is a difference in the two, appropriately, it needs to be recorded in the financial statements. One important judgment here is identification of the cash generating unit. Whether you look at one plant as a cash generating unit, whether you look at a set of 2 plants, whether you look at a segment, that depends on the nature and type of business and will vary accordingly. So these are some of the estimates that we get from management, which we need to understand from them and take appropriate evidence on their validity. So revenue growth, if a company has grown for 3-4% for the last 10 years and the management is estimating that from next year I'm going to grow at 15%, there needs to be a valid base. Maybe they've entered into new contracts. There's a new market that has opened up. We need to challenge them on the percentage that they've taken for growth. Similarly, for margins, is there any cost saving measure in place which is going to improve margins in future? What is it that has changed from previous years? A lot of companies don't take working capital adjustments and capex adjustments in their cash flow projections. So if you projected a cash flow of 100 over the next 5 years, you will also need new fixed assets to service those projections.
So the delta, the outflow on account of those capex items also needs to be considered as projected cash flows. Discount rates again, if you take a 5% discount rate versus a 15% discount rate, it changes the entire face of the projections. Just a simple example, risk factor. So if you have a long-term contract and that contract is fixed, you are going to get 100 rupees every year from that contract. So there is a degree of certainty and the risk factor involved is very low. However, if you are in an industry where revenue fluctuates or if your revenue is dependent on winning contracts in the future, there is a large amount of uncertainty involved there. There the risk factor will be high and accordingly the discount rate will be high as well. On terminal growth rate, having say a 5% terminal growth rate versus a 10% terminal growth rate changes the entire face of projections. In a developed country like the US, terminal growth rates vary from 2 to 3%. In India, on an average, we generally take 7 to 8% in line with whatever is our GDP growth. But we need to assess industry by industry, see what is the terminal growth rate that the management has taken. And if it is over or less than what is the industry estimate, then we need to challenge management. So again, we might not be experts in all these areas when we are looking at projections, but the idea is that whatever the management has told us, it needs to be challenged. The management needs to have a logical base and rationale for all the assumptions that they have taken. So 116, the new standard was introduced, I think, around 3 years back. I think a lot of us faced implementation challenges initially. So the idea here is to give an overview of that standard and what are some of the key areas where judgments are involved in 116. What are the common mistakes that we make and what are the things that we have to consider? So a small recap of what changed under Ind AS 116. All leases primarily are now finance leases, and you have to create a right of use asset and a right of use liability on day one. Instead of the expenditure going as rent expenditure, it goes as depreciation and finance cost. From the lessor's perspective, it is still either an operating lease or financing lease. The principles and criteria for identification for a lessor remain the same as earlier. So some key elements for a lessee also, there is a short-term lease exception. If the lease contract date or period is less than 1 year, then the management has a choice to not carry out lease accounting for those contracts. Similarly, if there are assets which are low value, the company has a choice, an accounting policy choice to not apply Ind AS 116. This is very beneficial for companies because it avoids a lot of work in terms of assets, say like computers that are taken on 12 months lease or printers are taken on lease. These are small value assets which can be charged straight away to the profit and loss, and you need not do 116 accounting for these low value assets. There is no monetary threshold of what a low value asset is. It needs to be determined based on the nature of the asset and the overall size of the company and materiality that is set during the audit. So initial measurement, broadly what is done now is, let's say there is a contract for 5 years for a property. What is the future expected cash flow over the 5 years is discounted to its present value, and a corresponding asset and liability is recognized. On the asset, depreciation is charged. The liability gets paid off every year through rent payments, but on the liability and interest portion comes. So earlier, whatever was going in rent was going in the P&L, now goes in depreciation and in the finance cost line. For a lot of companies, this has been beneficial because for investors who look at EBITDA, this is positive since the expenditure goes down in the depreciation and interest line. So this is a broad overview of how accounting is done for the lessor and the lessee. For the lessee, for short terms leases which are up to 12 months, there is an option. It can either be an asset or liability can be created or it can be charged to P&L. For long-term assets, it is recognized as a right of use asset on day one and a corresponding liability is booked. the liability increases by the interest amount and reduces by the payment made, and the right of use asset is depreciated over the lease term. For finance lease, from a lessor's perspective, it is treated as a receivable, and if it is treated as an operating lease, it is charged to depreciation. It continues in the old way. You charge recognize an income and charge depreciation on the fixed asset. So some of the common mistakes that we make and what are some of the things that we need to avoid. So I'll not take you through all, some of the key ones. So lease term. So let's say there is a contract which is for 5 years and it is extendable up to another 5 years. So there is a question of whether the lease term that should be taken for 116 should be 5 or 10. So this needs to be determined at every contract level. We have to assess the probability of extending that lease and at whose option that extension is. So if I have taken a lease for 5 years, I have an extension period of another 5 years, which is only at my option. And I have spent a substantial amount of money in getting that place ready. So there is a great probability that I will exercise that extension option. And hence, in that case, I have to take a 10-year lease period and not a 5-year lease period. So that option exists for taking a longer lease period in our case. A discount rate should be taken as the incremental rate of borrowing on the date of lease inception. This need not be changed every year. Whatever was the borrowing rate, the incremental borrowing rate when the lease was taken, that rate has to be applied. There needs to be a proper identification of whether any modification in a lease contract is a modification or is it a new lease contract in itself, since the accounting is different in both these cases. There are a whole set of disclosures given in the leasing standards. They need to be taken care into when preparing the financial statements. So another judgmental area similar to impairment, which depends on a lot of projection that the company makes, is deferred tax and MAT. With the new tax regime coming in, MAT is not any longer a problem for most entities, since most of the entities have now opted for the new regime under which MAT credit cannot be created. There is no payment under MAT. There have been subsequent changes in the current year as well. And companies who do not opt for tax, the new tax regime, future MAT credit will no longer be available to those companies. So any company that has not opted for the new tax regime, in most cases, will now adopt the new tax regime from 1st April 26. On deferred tax, I think there was a change that came when Ind AS was adopted. As far as deferred tax asset creation on losses was concerned, in the previous accounting standards, there was a concept of virtual certainty. So only if you are virtually certain that the company will make profits in the future, did you recognize a deferred tax asset. That was in a way simpler for us as well as auditors. There was lesser judgment involved. We could tell the management you can't recognize a deferred tax asset because virtual certainty is very difficult to prove. However, when IFRS came in, that was changed to reasonable certainty. And a lot of companies, given the long period to which tax losses can be utilized, try and create deferred tax assets based on future projections of profitability. So similar to impairment, where we looked at revenue forecast, capex, what is going to be the P&L in future, what is the terminal growth rate, what is the margin improvement. All of these things need to be considered in deferred tax as well when we are doing an assessment of deferred tax asset carrying value assessment. So for deferred tax as well, there are assumptions that are used in terms of future profitability that need to be challenged, and we need to document how we are as auditors comfortable on the projections that the management has made. Similar to impairment, discount rate and terminal growth rate needs to be assessed on a periodic basis. I think on the point that was raised earlier on the use of technology, so So progress has been made. I think every year the quantum of technology that we use in our audit has gone up substantially. There's still a lot of improvements to be made, but even we in our audit, so just to give you an example, in our year-end audit earlier, challan checking, statutory dues, for example, used to take a lot of time. You go through every single challan, you put that data in, see whether delays have been made or not. So we now have a tool which does that checking automatically for us. Similarly, for lease contracts for companies which have 100 and 150 leases, you would go through every single term, try to make a summary, but now there are OCR readers where we put in the agreement and the key terms that are relevant from an audit perspective for recognition of leases. All of that gets captured automatically. So we do have to see broadly whether what it has captured is correct or not, whether there is some outlier or not. But a lot of the manual work that was involved in our audit slowly and gradually is being taken over by such automation. So I'll give you practical examples of where we are using digital tools in our audit because it helps save a lot of time for us as well as for the company. In RPA, for example, bank reconciliation statements. The earlier days where you would take the bank statement, the book statement, try and compare every single item and find out reconciliations. We use robotic process automation for that. Everything that is unmatched comes out as exceptions and you can concentrate only on those exceptions rather than looking at every single line item. This improves the quality of audit because then you are not spending time doing manual work. You can spend quality time analyzing what those differences are rather than spending hours identifying those differences. Every company has ERPs. I think the future of audit is you get control over 100% of the population. A control might be in place. Howsoever you might check, if there are lakhs of transactions, you might go to 25, 50, 75, 100, but there's always a risk for the balanced transactions. I think the future of audit eventually is going to be checking 100% of those transactions, and process by process, I think we are trying to get there. Analytics and BI, I think the focus going ahead on audit again is moving away from vouching to identifying patterns where, say for instance, you're doing an analysis of sales. Maybe checking 100 vouchers might not give you the sort of comfort than, doing a detailed analysis of what are the markets where products have been sold. Is there a variance between, prices given to one customer versus the other? You do a day-by-day analysis of sales. If there is a spike of sales on the 31st of March, then that is an area that one would need to investigate because something seems unusual. So identifying patterns where you can focus your audit on is the way to go ahead on this. So OCR, for example, I said for lease agreements or for any other agreement, it's help capture data, supplier agreements, customer agreements. So the earlier traditional approach was you get data, you take out samples. From those samples, you try to identify mistakes. I think the new approach is going to be you take up data, you use certain logics to come out at exceptions. For those exceptions, you then take out samples and then focus on those samples. So you identify the problems through patterns first, then do your sampling rather than doing your sampling first and then looking for errors or mistakes in your work. So I'll cover this topic and later, so there has been a change in Ind AS 1. I think this will be relevant both for this year, March 26 closing in terms of current and non-current classification of borrowings. And then there is a change in the next year as well from 1st April 26. So there will be an impact in the next year as well. I think this is an issue that we face at all clients where there are borrowings in terms of covenant testing. So the first topic is on EBITDA. So there are certain clients that want to present EBITDA on the face of the balance sheet, which is not directly in accordance with Schedule 3. However, Schedule 3 does give an option that if the management feels that this is a more relevant measure for the users of the financial statements, then an EBITDA presentation is allowed. However, they have not given a detailed guidance on what constitutes EBITDA, and it leads to a whole divergent set of practices as to how EBITDA is to be calculated. There is a definition given in the guidance note on company prospectuses on EBITDA, which says that it is just earnings before taxes, depreciation, and amortization. However, in practice, we've seen companies look at EBITDA in a lot of different ways. Say, for example, other income. A lot of companies do not consider other income to be a part of EBITDA. However, if you look at just the general definition, other income should form part of EBITDA. Similarly, exceptional items. If you look at the definition here, given in the company prospectus, exceptional items cannot be excluded. However, most companies exclude EBITDA, exceptional items when it comes to EBITDA calculation. So there is no correct answer to this. I think every company has taken, there are industry standards as to what constitutes EBITDA. Other income, for example, logically should be excluded if you're excluding finance cost. Howsoever the company decides to disclose EBITDA, two things we as auditors need to ensure is one, it is consistent in its application. The definition of EBITDA cannot change every year based on how the financials look. Other income hai to hai, EBITDA mein nahi hai to nahi hai. Aisa nahi ho sakta. There needs to be a consistent definition, and it needs to be appropriately disclosed in the financial statements as well. I think EBITDA.
Credit rating agency don't take the other income then.
Sorry.
Credit rating agency.
Yeah, credit rating agencies don't take.
take the other income.
Even from a SEBI perspective, they say that since it has been defined as other income is not considered in the definition in the company prospectus, you do not consider it. But from an industry standard, I think most listed companies in their investor presentations, they include other income as EBITDA. If you ask my personal opinion, so if a company has taken a borrowing, for example, of 500 crore and it has not spent that amount, and 450 is lying in its balance sheet. So we'll exclude the finance cost when we take EBITDA and include the other income if you go by this definition, of which is not correct. So ideally it should be excluded. It has to be like to like, but then there are divergent practices, and the definition, the thing is definitions are a base. You cannot be considered as a final rule on anything because
Case to case.
Case
If
to
the
case.
other income consists of miscellaneous income written back, then it's not worth it.
Correct. So two things we should ensure is it is consistent. The company is consistent in its application of EBITDA. It does not change its definition every year, and it is disclosed appropriately in the financial statements as to what EBITDA constitutes. So these are some of the items that the companies generally tend to exclude when they are calculating EBITDA. ESOP cost, companies tend to show it as exceptional and exclude it from EBITDA. If there's a one-time write-down of inventories, if there's a fire that is done, termination benefits and restructuring costs are generally shown as exceptional and hence excluded as well. I think not in this slide, but generally a problem with exceptional items is that there is very little guidance in our accounting standards as to what constitutes exceptional items. There's a very general statement of it has to be based on quantity and the type, and it leaves it up to management judgment. So a lot of managements take very differing views on what constitutes exceptional items and what does not. So this is just a sample presentation of what is an EBITDA reconciliation. So even from the investor's viewpoint, this is important, but another important area where EBITDA impacts is on covenant testing. Generally, it is agreed with the bank of what would constitute EBITDA when they look at ratios, but there might be instances and cases where a new item has come up. So when you entered into an agreement with the bank, maybe the company did not have ESOPs, and 2 years down the line it has ESOPs, and that ESOP charge is the difference between whether a covenant is being met or not being met. So these are things that can have a significant impact, and if the covenants are not met, classification, repayment, all of that gets impacted. So we need to obtain and read loan agreements. If the loan agreements are not very clear as to what constitutes EBITDA or whether the covenant is being met or not, we as such send bank confirmations. We should also try and get a confirmation of these covenants and any terms where we have a difference of opinion with the management on. we should recalculate covenant ratios. The management calculates those ratios on their own. Generally, it is submitted to the bank on a quarterly basis. We too should test those at a base level. This is also required for Caro now, where in Caro you have to see whether the management has submitted the covenants or the calculations that they've submitted to the bank on the quarterly basis. They align with the books of accounts or not. We have to inspect compliance certificates and supporting schedules, and relevant books of accounts for those covenants need to be tested as well. Evidences and subsequent events, I'll come back to, so we are on this topic, so maybe we can take that as well. So historically, what we have done is, if there is a breach in covenant, the breach happened somewhere on 31st March, we are signing in September. According to that breach, if there is a breach in covenant, the company would have, that loan becomes repayable on demand. So there is a question of whether it will be current or non-current. However, what management generally does is it goes to the banks and gets those covenants rectified, or they get an extension letter from the bank to that extent. So historically, how have we classified such a breach when we are signing off? So say, for instance, 31st March, a breach existed. We audit in July, and we are signing off in July, and in June, the management gets a waiver for that covenant. And the breach of the covenant would lead to a loan being repayable on demand. So how would you generally classify that when you are signing? Would you classify that as current or non-current? So we've generally historically classified it as non-current. We say, since the letter has been obtained from the banker that there is no breach, as on the date of signing, we will continue with the original agreement and consider as there was no breach done. From next year, April 21, 2026, the Indian accounting standards and global standards are being aligned, and all these events subsequent to the balance sheet date will be treated as non-adjusting events. So if there was a breach on 31st March, because of which a loan became repayable on demand, it has to be shown as a current loan for which there has been a breach, and you will not be able to take into account any subsequent rectification that has been done between the banker and the company. So we'll have to align with clients proactively before the year end to ensure any such waiver letter that needs to be taken is taken before the end of the reporting period. So common misstatements, definition, precision, I think we've covered. Exceptional is the most judgmental area. Every company has a few items every year which they might deem to be exceptional. It has to be seen on a case-by-case basis. So if there is an inventory write-off every year, and such is the nature of the business, to classify that as exceptional might not be correct. So those are some of the things that we need to take care of when calculating EBITDA and when looking at exceptional items. So consolidation is so as in when companies grow, the quantum of mergers and acquisitions has grown substantially in the last few years. Consolidation becomes very important in that regard, both as far as day one accounting is concerned, and then subsequently doing consolidation on a yearly basis becomes a challenge. I think for a lot of companies, for an overwhelming majority of companies, this is done manually. And in a manual consolidation, there is always a risk of error. So covering some of the key points that are involved in the consolidation process. So consolidation is fairly simple. You have the starting base is the 4 set of individual financial statements, say for instance, in a company which has a parent and 3 subsidiaries. So 4 financials, that is the base. You add all those financials line by line. That is step 1. Step 2 is eliminate intercompany items. So if there's a loan given by one company, loan taken by another company, that needs to be eliminated. The balance sheet is the easier part. However, you also have to look at revenue items. If there's a revenue of one, purchase of the other, that needs to be eliminated. If there is inventory lying in one place, then the profit on that inventory needs to be eliminated year on year, because it is a profit that has not accrued outside the group. It is between one entity to another entity. So these are some of the most common consolidation adjustments that are done. At the time of purchase, under the new accounting standards, a fair value assessment needs to be done. So if 100 is the purchase consideration, all assets and liabilities are identified, and whatever is the delta is recognized as either a goodwill or a capital reserve. And the NCI needs to be calculated. NCI is the share of the minority shareholder. So if you hold 90% of an entity, 10% is the share of the non-controlling interest, and every year's profit needs to be allocated to NCI as well. So NCI needs to be updated every year. There is an NCI that is identified at acquisition. There are two methods. There is fair value, and there is a proportionate amount of the net assets identified. The initial NCI is then changed every year. The share of profits is added, the dividend is subtracted, and the closing NCI balance is then created. Generally, in our experience, companies go for proportionate share method. Very few companies do a fair valuation of non-controlling interest.
If parent company sold the assets from subsidiary company, then how will you work out in consolidation?
So if the asset is sold, so let's say the asset in my books was 100, is the cost at which I purchased from the third party. And then I've sold it to my group company for 150. So in their books, it is now lying at 150. The ultimate aim is to bring it down to 100. So you will eliminate the sale and purchase on day one itself.
Yes.
Depreciation will also continue at the original value at 100.
Who is subsidiary or parent company?
So at an individual standalone level, so see two things. So if there's entity A and entity B, at 150, entity B will claim depreciation. At entity B, it will be at 150 only. However, that depreciation also needs to be eliminated at consolidation. So this leads to challenges in deferred tax also, because your book base and tax base becomes different. So some of the key points to be kept in mind. One is definition of control. Here again, in the old standards, it was fairly simple. 50% and more used to be consolidated. But the new accounting standards say even if you have 60, you still need to go and assess whether you really control that entity or not. Or even if you are less than 50, even if the control is not there in percentage terms, if in actual terms you're controlling how the entity operates, then again it needs to be consolidated. Accounting policies need to be common across the group. Goodwill has to be calculated accurately on acquisitions. This is a very important point, not just from an audit perspective, but ever since there have been changes in taxation rules on goodwill, where it is now very clear that no depreciation can be claimed on goodwill. That initial calculation of identification of assets and goodwill is very important for the company, because there is a direct cash impact on tax. And NCI needs to be calculated properly every year, and all intra-group transactions have to be eliminated. I think most of them get eliminated on a year-on-year basis. There's a sale, there's a purchase, there's a like-to-like transaction.
Shareholding pattern. Holding company, subsidiary company. And the holding company buys more shares in subsidiary company. Then how to reflect those things?
So it was already a subsidiary in your case.
Earlier.
Okay, and then you just put in more money. So again, in this case, standalones will change, respective standalones. On a consolidated level, there will be no impact.
The holding is in the exception or in the that year only?
So non-controlling interest is generally seen at a consolidated level. So if you are holding, so when the parent invests more in its subsidiary, there is no change in NCI because the external stakeholders remain the same. When the external stakeholder changes, at that time you have to do a revaluation again.
Holding is more holding in that subsidiary. So then the interest will be effective.
Correct. So if it is not 100%, it is less than 100%, the quantum of NCI goes down, then it will change accordingly.
So we require the retrospective effect in the earlier.
No, prospective effect. Prospective effect.
Retrospective.
Yes. Because let's say,
Impact is also there to that extent. Goodwill part and other part.
I think goodwill will not change. I can recheck, but because goodwill is created, goodwill changes when you move from a non-subsidiary to a subsidiary. But if it is already a subsidiary and you are putting in more funds, the goodwill amount gets frozen there.
Here in the. That is the reason. So then holding and non-controlling changes, so they just required to rework out from the inception. So goodwill is increased. That is impact of the goodwill and the capital.
So if I have, because say if I have, I can recheck. So if I have invested in a subsidiary, I have purchased, I have identified the total value. I bring in 100% of the assets of that entity in my books already.
100% is different. 70, the 60 and then.
No, so even sir, if you hold 70% in an entity and you have paid 100 rupees for that, you bring the entire 100 rupees worth of net identified assets into your books. You do not bring 70% of the net identified assets into your books. The allocation of profit happens on NCI. You will not rework goodwill every year again and again.
So NCI will see there.
NCI will reduce, but the goodwill amount will not change.
Effect of NCI reduction is going goodwill.
So
No.
the acquisition profit of that,
So goodwill is certainly only at the initial recognition, and then if the stake increases from 60 to 75%, the difference will go in your reserves, not as an additional goodwill. That is the guidance given in the standards.
That is free because of free profit and subsequent profit. That is the criteria.
No, so goodwill will not change. So let's say, for instance, your NCI value and current is 100, and if you are paying 120 for it or 80 for it, whatever is the delta goes to retained earnings. It does not go to goodwill.
you're paying extra for those.
So it will go to retained earnings. It will go to retained earnings, not to. So moving on to some regulatory updates. So just recently, NFRA has come up with a circular defining the communication that needs to happen between the auditors and the and those charged with governance. All of those rules, the underlying standards remain the same. NFRA is only re-emphasizing all those things and saying you need to have a formal policy in place with respect to your communication with those charged with governance. So during the course of the audit, you will meet the CFO, you will meet the audit committee chairman, you will meet the MD. Generally, none of that is documented. It becomes part of our normal audit procedures. The intent of NAFRA here is to say everything, every discussion that you've had with the board, with the charged with governance, needs to be formally documented. What is it that you communicated? Did you communicate everything that was required under the standards? What is it that those charged with governance came back to you? What were their inputs? Whether you looked at their inputs or not? All of that needs to be documented. There needs to be a formal policy in place. So for example, NFRA has been challenging, if you meet the audit committee and you are not meeting the board, are you really meeting everybody that under the standards is defined as those charged with governance? So here again, there is a degree of judgment involved. Every company will have its own set of rules as to our own assessment of what constitutes those charged with governance. So
Leave the board, entire board.
There's not a practice till now. So I think what they are saying is if the MD is not part of your audit committee, or if he's not attended the audit committee, did you communicate that with him? The 3 members who are not part of the audit committee but part of the board, are they really aware? Have you seen whether the audit committee has appropriately discussed all of that with the board or not? So those are some of the challenges that we faced in our own inspections, where they say you really need to have a strong logic for what constitutes those charged with governance or not. I think in most cases, this problem does not arise because a lot of board members do attend audit committees as well. or you separately meet the MD and the CFO. But then I think that is the ask that is coming from their side, that how do you justify that the audit committee itself is sufficient for you to communicate matters to, and why do you not communicate to the board?
Audit committee, only board.
Agreed.
Board, all the board members attend the audit.
Then it should not be an issue. So I'm not saying this is what they've specifically asked, but this is some of the points that they've raised recently in our inspection. Yeah, circular. So again, in the circular, they say all this was already existing.
Binding. It's binding.
Right. On Afra client sessions.
So Nafra circular says all those charges governance contribute to all the board members, but then board can decide if audit committee plus some management can be defined as those charges governance. So whomsoever board nominates as those charges governance, we need to communicate with them.
But practically how it will happen if NAFRA is going with the base assumption that everybody is those charged with governance, generally companies will not take a position that no, for me, this subset is those charged with governance, because the board will have to approve. So we will end up in a situation we are communicating with the audit committee chairman, then we are committing with the audit committee, then we are again talking to the board. So it will lead to duplication of effort and duplication of documentation.
The responsibility of defining those charges governance is
Management. And we need to validate that. See, a lot of this, all of us. So those charged with governance includes board in consultation with the CFO. So we've already, I think all of us as part of our audit already do all of this. I think what NAFRA is emphasizing on is you put it on paper. In a way, I think it is good for us as well. It forces those charged with governance to take responsibility. If I look at it from an auditor's viewpoint, everything is not left to the auditor and the finance team. Audit trail was a change that came 2 years back. I think a lot of companies face challenges here in terms of reporting and qualifications. Even some of the biggest companies of India have qualified reporting under audit trail. I think the ask from the government is that if you have an ERP, any transaction that happens, any change that happens needs to have a log maintained. And then you need to see whether that log is editable or not, and you have to report it in your auditor's report. So in our experience, what we've seen is that a lot of companies have this reporting on audit trail, and they are looking at ways and methods to get rid of it. And from the last year, there was a new requirement as to whether appropriate logs were maintained for a period of 8 years. So in the first year, there was a requirement of whether there is an audit trail or not. And then in the second year, there was a requirement of whether that audit trail is maintained for a statutory period of 8 years. So I think management needs to ensure that the correct accounting software is used. There is appropriate oversight by those charged with governance. Each software should have audit trail feature, and where changes were made, who made those changes, what was the data that was changed. It is protected from any modification, and it is retained as per the retention requirements of 8 years. So here again, we need to proactively engage with management, because IT systems cannot be changed right towards the end of the audit. So we need to check with them as to what software they're using, whether it meets the criteria that is required under the Companies Act for audit trail maintenance and record retention. So I think a lot of companies have had this challenge. A lot of qualifications have come. We have not heard a significant amount of queries from ROC or any regulators in terms of qualifications. Maybe they are giving in a bedding in period that take time to rectify this. But as of now, at least in our clients, in my experience, I have not seen a lot of regulators or ROC come down and ask why this qualification is there.
One or two cases I heard is imposed penalties also. There is a 5 lakh penalty for not complying.
So the 5 lakhs is the General Companies Act penalty, I think, not specific for this section. You've seen cases where Ronak, have you seen anywhere where? So in our clients, we've generally not seen, and most of them have this qualification in place. So even if you look at some of the largest clients of the country, they've decided to live with this qualification because the cost of rectifying this, they believe, outweighs the benefit to them as a company.
Because that earlier 8 years, they want to audit their.
Yeah. So from the date it has come, so yes, it needs to be retained.
Now only 3 years audit will be up.
Going forward, I mean, they want you to retain for a period of 8 years.
Where this qualified opinion should be.
So there's a specific under 143 reporting where you report on certain specified matters. There's a specific section where you need to report. So there's a guidance note of ICAI which gives draft language as well under various cases. What is the language you should put and where it should be put? So there are 2-3 clauses that get impacted. Because if you are saying audit trail is not appropriate, in a way you're also saying books of accounts as required under the Companies Act is not appropriate. So you need to give a cross reference to that also. So not a lot of changes in accounting standards in this year. I think going forward in 2027, there is going to be a lot of change in Ind AS 1 in the way financials will be presented. Maybe we'll be back here next year and we'll run you through those changes. But as of now, it's not impacting us. In the current year, there have been very minimal changes. And I'll run you through one of those changes which we discussed in covenant testing in terms of current and non-current classifications of loans and liabilities. So I think 2-3 things which these amendments, they say they clarify, and this was always the intent, but the clarifications have come in. First is on liabilities, whether there is an intent of management to repay a borrowing or not repay a borrowing should not impact its current or non-current classification. The current and non-current classification has to be as per the terms of the loan agreement. So there might be a situation where you've classified a loan as non-current as on 31st March. And by the time you're signing the balance sheet in September, it has already been repaid. But the intent of the standard is it still should be shown as non-current when you're signing off on your 31st March balance sheet. You can give an appropriate disclosure to the effect that that loan has been repaid subsequently, but the classification cannot depend on the intent of the management. How the earlier standard was defined was it can be shown as non-current if there is an unconditional right of management to defer the loan for a period of 1 year. So let's say, for instance, as on 31st March, all covenants are being met, and it is dependent upon the fact that it remains non-current is dependent upon the company satisfying those covenants for the period of next 12 months as well. For a listed company, you might sign in May, and there is a huge chance that the company might default post-May. So can you really say the company has an unconditional right to defer? Because a lot of things, or those covenants might not be under the control of the company. So we were taking differing positions again earlier as well. I think most of us classified it as non-current if as on the date of signing all covenants were met. But the standard has now been further clarified to say that it is not unconditional right. There has to be a right to defer. So you have to look at that right to defer at the end of the reporting period and not at any period subsequent to that. So all covenants need to be tested as on 31st March. If you are okay as on 31st March, you classify it as non-current. If you are not okay as on 31st March, you classify it as current. There can be a lot of permutations and combinations, and maybe we'll run through three, four of them to get an idea of what these changes constitute. So let's consider a scenario that there is a loan agreement that requires compliance with debt covenants at the end of each quarter. And the entity has complied with all covenants as on 31st March 25, which was the reporting period. And the entity expects to comply with the covenants going forward also. However, Whether compliance happens or not is not in the control of management, but as on 31st March, they are compliant with it. So in this case, the standard has made it very clear if you were compliant on 31st March, even if other covenants post 31st March are not under your control, it has to be classified as non-current. There is no breach of any covenant. Let's consider the same scenario where the loan agreement was there, but in February, the entity anticipated that as of 31st March, there will be a breach of agreement. And it entered into an agreement dated 15th March with the lender, and the lender agreed to waive covenant testing as on 31st March. Now, if the covenant testing has been waived off as on 31st March prior to the reporting date, as on 31st March, the company is clear, it will be classified as non-current.
That is the position if there is something ever and after 31st March. And 31st March, the position was good. Then you don't check that combination of that.
Sorry, I didn't get it.
You are talking about everything we have to go by after 31st March.
Yeah.
After the first one, now that we March,
Yes.
but something happened bad afterward. That will slow down.
No. So if you were compliant with debt covenants as on 31st March, you are signing in May, and you are not compliant with debt covenants as on 30th April, you will still go as non-current. You will not take cognizance of that. So what has now become important is whatever happens on the board date is important. So what had happened historically was we also went up and took letters from bankers stating that even though there was a default on 31st March, we sort of let go of that default. We will not demand repayment. Even in that case, if it is happening now subsequent to 31st March, you cannot take cognizance of that and you'll have to classify it as a current.
Put in just for the point of classification.
Classification.
From date, but if there's a, it can be reported as subsequent period.
Yeah, this is from a reporting perspective. I think if there is anything which the company feels is important for users, you can disclose that as a note.
Because for the purpose of classification, I understand that non-current, but it's a default and
Yeah, so
it's occurring after balance.
no, agreed. So let's say you are assessing going concern, and if you have to repay that loan, your ratios look very bad. So even if you've disclosed that in the financial statements and you've taken a subsequent waiver from the bank, you can disclose that in the notes to say that it is not repayable because I've taken a subsequent waiver. I think yeah, it has become redundant. So you have to look at what is there as at the end of the reporting period. That is the most important criteria.
Redundant is there. Jointly, we have to look at it.
Yeah, so
together.
So there are two parts. One is the right of deferment, or looking at covenants as on 31st March that takes place in the current year itself. And the fact that you don't have to take into consideration management likelihood of settlement, that also goes into effect in this year. On the fact of getting a subsequent waiver letter from the bankers, that goes into effect from 1st April 26. So global standards were always this way. It is only the India's one had a separate line for this that has now been removed and will be removed going forward. Other than that, there are some changes in terms of disclosures required for supplier finance arrangements or Pillar 2, but those are very immaterial. They are more from a higher disclosure perspective with no material impact on the financial statements. The only major change came in Ind AS 1. I think no material changes are expected in the next year also. 1st April 27, if plan goes according to what it is now, the Ind AS 1 will change completely and the way financials are presented will change completely. But I think that is under discussion with ICI. And depending on how that progresses, that will be a major change for us as professionals in the next 2 to 3 years. I think GST changes, we are all aware of some of the accounting things, accounting applications and implications that we need to see. Is its impact on inventory? What is the recovery of ITC? If ITC is being accumulated, whether there is a inverted duty structure that is coming. But from a, so these are some of the accounting impacts that need to be seen. Happy to take any questions with regard to updates. Yes.
Thank you, sir. Friends, as we all know, the yearly audit period is the most important time for CA. And today's session has beautifully highlighted the critical consideration, latest update, and key focus area that every auditor must keep in mind while analyzing the audit. Members are requested to please be seated in the board of thanks. Friends, both CA Sidhant Rishi and CA Ronak have not only explained the technical aspect but also shared practical experience and real life perspective, which will certainly help all of us in handling our upcoming assignment more effectively. And I am sure every member present here has taken away valuable insights that will strengthen our professional approach during this audit season. Before I invite vote of thanks to our deputy convener, friends, itinerary of Georgia tour has been given in the group, and really Georgia is a very beautiful place, and every will enjoy, we enjoy a lot. Who will be want to go? Request everyone to please give your name as soon as possible in the today evening or latest by tomorrow evening. And one more announcement we can announce, and I invite our past convener managerial area to give one big announce for our next meeting.
Slide. So, thank you, Kadalpati, and good morning to all. Thank you, Sri Ronak Saji, and Sri Sidhant Rishi, leading teaching session for considerations. On behalf of JB University Study Circle, I propose a hearty vote of thanks to our learned speakers, and also like to thank all members and admin staff for the first service options. Thank you.